Hey guys, welcome to HipHughes History. We're going to hit you up with a little bit of the Federal Reserve System today, how exciting it is to dive into monetary policy. I'm not really going to dive, I'm just going to ice skate right across it. But you've watched 15 conspiracy videos and you finally found the one you need for your test right now. So why don't we go giddy up for the run and go see if we can't grow our brains 10 times its size. Let's go get her done right now. All right, guys, the Owen Glass Act, or the Currency Bill, or the Federal Reserve Act was signed by Woodrow Wilson in December of 1913. But we want to backtrack a little bit before we explain, and maybe in the next section, exactly how the Federal Reserve System works. But basically, prior to 1913, we did have a couple episodes early in the Republic with a national banking system, but it was a much weaker national banking system, and eventually those charters ran out. So by the end of the 19th century, you really have a private banking system, which is in a sense kept to the whims of the economic cycles of capitalism, the booms and the busts. So in a sense, before 1913, there was no national money. Banks would give their own banknotes out, which were generally recognized, but not always across state lines. But the bigger problem was when these banks ran into trouble, when everybody would demand their money because there was a panic. People would bring their banknotes in for gold or silver. Eventually, the bank would run out of Momo. And this isn't good for the confidence of the consumers. So in 1907, there was a banking crisis, which was so bad, eventually the bigger banks had to come in and kind of bail everybody out. So at that point, the federal government created what was called the National Monetary Commission, which was set with coming up with some ideas about how we could create a more stable system. At the heart of the matter is the federal government, and there's going to be people that disagree that this is the federal government's job, but really doing something to stabilize the economy, to be able to control inflation, to control unemployment, to set long-term economic growth, but still have it under a private umbrella. 1913 is a huge year. We're going to get tariffs dramatically reduced, and because they were dramatically reduced by the Woodrow Wilson administration, there was a need to gain revenue from somewhere else. So we're going to take your money, Richie Rich, and we get the 16th Amendment, which was passed in 1913 as well. So this is a year of economic regulation, and the federal government's now going to come in and try to regulate the banking system with the Federal Reserve Act. You can call it the Currency Act. You can call it the Owen Glass Act. I really don't care. But now let's break it up like a Kit Kat bar and look at kind of the three main segments of the Federal Reserve Act, which create the Federal Reserve System, which creates monetary policy in the United States of America right now. So let's do it. So I guess the best way to explain in a few words what these Federal Reserve banks are going to do when they're going to create 12 regional Federal Reserve banks, which are going to kind of control the monetary policy through the board of directors. But basically, they're the banker's bank. Like, you can't go to the Federal Reserve Bank and go, "Can I see a teller? I'd like to talk to a teller." Well, you can't. But the key is, and I guess this is kind of the quasi-mix between socialism and capitalism, is that the banks themselves, these Federal Reserve banks, and all banks deal with the Federal Reserve banks. Some banks are special, they get special privileges, they're called national banks, but everybody's got to get their money from the Federal Reserve Bank. And these Federal Reserve banks are owned by bankers. So bankers buy stock in the Federal Reserve Bank, even though the profit goes to the United States government. But the bigger idea is that these stockholders elect the president of the Federal Reserve Bank. But these Federal Reserve banks are completely in the private sector. They're owned by bankers, like we previously mentioned. But they're regulated and they're controlled by the Board of Governors. The Board of Governors consists of 7 individuals, although there's only been 5 on there for quite a while, that are appointed by the president. These are the government representatives in a sense. They serve 14-year terms, so they're very buffered by the length of term they're in from any type of outside influence. And one of those 7, which is nominated by the president, becomes the chairman of the Federal Reserve, and that person serves a 4-year term in that position, which is renewable. But these are the ones with real power. And again, we're going to say this 5 times because it's on the test. They regulate the monetary supply, right? They're going to make sure, or try their best, that we don't have deflation, we don't have inflation, we have healthy employment, and we have a sustainable economy over the long run, although there's people that would disagree that they have served that mission well. But either way, there's a few ways that they regulate interest rates. Number one, since all banks have to come to them, they're able to charge an interest to those banks. And by adjusting that interest rate, they're controlling, in a sense, what those banks are going to charge you, the consumer. This is called the discount rate. The discount rate that these banks are going to get. So let's say the discount rate is 5%. That means when the bank lends you money, it's going to be more than 5%. So what the Fed can do is control that discount rate. So if there is inflation, if there's too much money out in the system, then they can raise the interest rate, the discount rate, and then banks are going to raise that rate on you, the consumer, which is going to slow spending, slow down, don't spend so much money. But if the economy is very slow, they can lower that discount rate. That'll flood the money with new loans, with new housing, and that'll stimulate economic growth. So in a sense, they're kind of controlling the forklift of the economy just a little bit. There's also something called the reserve requirement. This is how they regulate banks. They go, look, you can't run out of money. They did that in, Mary Poppins. There was a run on the bank. Everybody wanted their topping.
There's something wrong. The bank won't give someone their money. Well, I'm going to get mine. Come along, young man.
Stop all payments. Stop all payments.
So we can't let that happen. So you have to have a certain amount in there. And if you can't have that amount, you need money really quick. You can borrow from each other. And that is called the federal funds rate. They control that interest rate as well, the rate that banks can lend money from each other. So both of these are forklift buttons on the economy in order to contrast it and to expand it. Now, it's important to kind of put this distinction down again. They are independent. They're a government agency, but they're not beholden to anybody. Congress can't tell them what to do. The president can't tell them what to do. Congress can investigate, and the chairman of the Fed might be called to Congress in some type of investigation, but they are supposed to be free from that type of influence so they can concentrate on strengthening the economy. Now, like we previously mentioned, the actual banking in the Federal Reserve System occurs at these 12 Federal Regional Reserve Banks, which are owned by bankers. They are the ones in charge of printing the money. All of the transactions, checks and credit, everything gets put through that reserve system where everything is cleared for a final approval. They also catch counterfeiters, and they also, like we said, lend regular banks their money. So in a sense, like we said before, we'll say it again, they are bankers' banks. Now, I said there were three different parts of the Federal Reserve System. We've talked about the board of directors, we've talked about the actual district banks, and now it gets complicated because there's something that's called the Federal Open Market Committee. Federal Open Market Committee. And this is a institution, a committee, which is run by 12 individuals. And they do something very important. They have actually much more power to actually determine what the actual money supply is. And this is going to go way over my head, so I'll keep it very simple. But basically, they decide how much debt, government debt, they should buy or sell. And by having the ability to do that, if they decide to, for instance, sell lots and lots of debt, then they're getting rid of money. That's going to limit the monetary supply, and that's going to create a lowering of inflation if that's a problem. But if it's a very slow economy, they're going to buy lots of debt. That's going to put more money out into the economy, and that's going to hopefully result in employment and a stronger economy. Now, they meet 8 times a year. It's really important when they meet because everybody's listening. Wall Street is listening, for instance. And this is where it gets maybe a little conspiratorial because you would think, who's on that board, that committee? That's really important. How do you get on there? I want one of those jobs. Well, if you want to be on the Federal Open Market Committee, you either have to be on the Board of Governors of the Feds. There's supposed to be 7 individuals appointed by the president, but right now there's only 5. So there are actually only 10 members that are in the Federal Open Market Committee. The 5 board of directors and then 5 heads of Federal Reserve banks. I know I said there's 12, so they rotate them. But hold on, they don't rotate all 5. One of them gets a permanent spot on this committee, and that would be the president of the Federal Reserve Bank in New York, because it's said that they're so powerful because of Wall Street. Wall Street needs a larger role, so they have a permanent role. So you have at least 5 bankers, and then you have 5 members of the board of directors. You would hope that they would be some maybe public advocates on there, and sometimes there are, but sometimes there's some bankers too. So at the end of the day, even though this is a government-created institution, we have to kind of boil it down to the fact that when they do what's called quantitative easing, that's what it's called when this Federal Open Market Committee kind of regulates the monetary supply through dealing with buying and selling debt. I bit my tongue, that's so complicated. But basically it's bankers doing that. So if you're confused, I'm probably a little bit confused as well. But if you get the basics down, that the feds regulate the monetary system, you understand the concept of interest rates, and maybe you even get the Federal Open Market Committee under your belt, you'd be a pretty smart cookie. How about that? So let's investigate a few criticisms of the feds, and you can leave it down in the comments below, because I know, there's people, they have tinfoil hats on fire when you talk about the Federal Reserve Act. But I'm not going to get into that because I just do the teaching on the YouTube. You can leave it in the comments. So let's check out a couple critiques of the Federal Reserve System. So interestingly enough, when this was actually passed, people that were against banks really wanted it because it was seen as a way to rein the banks in, to keep them under control, and to keep the economy legitimately strong and not under the whims of bankers and Wall Street elites. The people that were pro-bank wanted nothing to do with the feds, but obviously the system has evolved, and in a sense it's kind of flipped around. People that are against the banks sometimes are against the feds because they believe it's a banking cartel. It's controlled by banks for the benefit of the elite, of the wealthy, of the upper class. There's also a constitutional argument. Certainly in Article 1, Congress has the ability in Section 8 to coin money and to regulate the value thereof. But in terms of regulating interest rates and where the power comes to actually create the Fed in the first place, there are constitutionalists that look at the Constitution and say, "Where are you? I can't find you. You're not in there." And certainly there's people that believe there's collusion between the government and Wall Street and how the feds put policy together. There was a lot of criticism prior to the crash in 2008. It was Alan Greenspan who was in charge, who really argued for a deregulation model. And there are people in the economic world that say that deregulation caused banks to take huge risks that they shouldn't have been taking, gambling with people's pensions and with their stock portfolios. And at the end of the day, they lost and we paid out. But of course, there is the argument that deregulation could be a good thing as well. So there's lots and lots of different theories, and I know you're going to leave them down in the comments below. I bet you we even get a couple conspiracy theories because that happens. So why don't you guys do that? Thanks for watching. We hope that you're a little bit smarter than when you press the button, and we certainly hope you check out other HipHughes history videos. We have tons and tons of them. We want you to be a subscriber. Come join us. And I say it at the end of every lecture because I mean it with all my heart. Where attention goes, energy flows. We'll see you guys next time that you press the buttons.